Good morning, good afternoon, and good evening. I am Emma Joyce, Head of Community at Global Digital Finance, and it's my pleasure to welcome you to this Global Leaders Town Hall in partnership with the Global Blockchain Business Council with special guest John Salmon, patron member of GDF and partner at Hogan Lovells. Lawrence Wintermeyer, Executive Co-Chair of GDF and GBBC UK Regional Ambassador, is hosting today's Town Hall, and John and Lawrence will discuss the challenges to existing regulatory structure for blockchain. They will also look at where the UK goes post-Brexit and explore who has the best infrastructure for blockchain within Europe. John Salmon is a partner at law firm Hogan Lovells and has been a leading IT lawyer for over 30 years. He has specialised in advising in the financial services area for 20 years. John advises financial institutions, technology providers, and new fintech companies on innovative digital projects. His work covers IT procurement and outsourcing, cloud projects, cybersecurity, mobile payments, and digital platforms. John is a recommended individual for technology and telecommunications in the leading legal directories and lectures and writes extensively on the subject of IT and e-business legal issues relating to financial services companies. John leads the firm's blockchain group and is particularly focused on the application of blockchain in the financial services sector. He is well regarded in the industry for his knowledge of the legal and regulatory issues presented by blockchain and has spoken on the topic at industry conferences, including the Market Force Blockchain Summit, FinTech Connect Live, and London Blockchain Week. He has also given evidence to a number of national and supranational entities on their approach to crypto assets, including the UK government, European Union, and the OECD. We welcome and encourage your questions. If you have a question, please feel free to submit it at any time using the Q&A box located at the bottom of your screen. I hope you enjoyed today's session, and I'd now like to welcome Lawrence and John.
Thank you, Emma, and a very warm welcome to you, John Salmon, on the Global Leaders Series.
Thanks a lot, Lawrence, and thank you, Emma. I barely recognise myself.
John, before we get on to blockchain, DeFi, and the European reg landscape, I was hoping we could spend a few minutes on COVID. Look, for the past few weeks, we've been focusing on reopening everything. Looks as if, certainly in the Americas, the numbers are going back up again. Parts of India, parts of Asia. Now, Hogan Lovells, with more than 40 offices around the world and 3,000 some employees, how are you managing through this crisis?
Yeah, thanks, Lawrence. It's a good question, and it is interesting when you speak to colleagues around the world. So, yeah, I mean, there's actually about, I think there's 9,000 odd people in Hogan Lovells, and as you say, across 46 different offices. And
9,000.
You speak to people in Germany, and obviously they're back at, some of them are back in the office, and in parts of Asia, you know, they're back in the office. Paris, I know many, you know, most of them are back in the office in Spain. So there's certainly parts of Europe and Asia where we are back in the office. And as you say, the US has gone backwards. I think it's a tough time for everybody to try and work out what's best for individuals, what's best for clients, what's best for teams. You know, I think we've adjusted extremely well to being out of the office, and, you know, being a lawyer, you can kind of do that broadly from anywhere. But I think it's difficult to have the same team dynamic when you're not in the office. So I think lots of people are missing it, and you know, and I think it's getting it at the right time and the right level is the crucial thing, right?
You raise a really good point. I know Hogan Lovells is particularly, you know, technologically enabled, and you've adapted very well, you know, to having remote work going on. But I sense in our own community, again, the conferences and, you know, gatherings, places like the OECD, where we get numbers of, you know, people together and really, you know, do quite a bit of advocacy work in the back channels. People just seem to be missing that.
I think that's right. I think people are missing that. I think people are missing the camaraderie, right, of meeting up, and, you know, you can have as many Zoom chats as you like, and, you know, you and I have had plenty, right? But it's doesn't quite seem the same. It doesn't seem quite the same thing, does it? You know?
Yeah.
I also think it's hard because, you know, connecting with people, you're never very sure how busy they are, because I think lots of people have been extremely busy and extremely under pressure, both from a business perspective and from a personal perspective. You know, so many people have got young kids or homeschooling children, and that's really quite tough while, you know, trying to hold out a full-time job. You know, so I think the whole thing's been pretty hard on people, and, you know, it really does depend on your family situation, how old your kids are, and et cetera, et cetera. So, I mean, I'm hoping that there will be, you know, on the positive side, some great things come out of this. You know, certainly within the big financial institutions that I talk to, I think it's definitely given more of a fillip to digital transformation, and, you know, the notion of digital first. I think, you know, I guess it's probably been the last 10 plus years where people have trotted that out and said, we want to be a digital organization. It's at the heart of our strategy. We want to, you know, digital first, et cetera, et cetera. I'm not sure that everyone has really lived that and really necessarily believed that throughout the execs in financial institutions, and throughout the, you know, that kind of level below the execs, perhaps. And I think what this has shown people is that actually digital is very important to their business, to driving it forward from a positive point of view of engaging with customers, but also the technology infrastructure that they have is vital. I think we've all found that, right? If the technology doesn't work, we can't do anything. And I think the regulators, I suspect, are going to look at that operational resilience and technology resilience more carefully going forward. They've already been, you know, you can sense in the last couple of years they're looking at that. And I think boards and the regulators will only have a greater understanding of how vital that is to get it working. Otherwise, really, you can't do business anymore.
You know, John, you raise a very good, interesting point. I mean, one, I couldn't agree with you more, and you know, hope that particularly in the financial services sector, people will recognize, you know, not everyone needs to come into the office every day to get the job done. Clearly, there are critical and essential staff. And on the topic of resilience, you know, putting aside the healthcare systems in most of the countries, which we're all in awe of for really getting through the bulk of a crisis, which, you know, has almost crippled some, and looks as if it may be starting to cripple a few more with the second wave. But the financial services sector, for the most part, I think is, you know, proven very resilient through this. So I think there'll be lots of learning as we go along. I mean, if you think that, you know, in the first time, I think in history, and certainly in the modern times, in our forbearance system, we've locked everyone down in, you know, broadly in the West, and things have still managed to, you know, chug by with, you know, really a minimal amount of issues. There haven't been any large continuity issues, to the best of my knowledge, in financial services. That's actually pretty. That's pretty good, isn't it?
It is. I mean, it is. I agree with you. It's fascinating, Lawrence, actually, as a kind of, you know, from when we look back in history, I'm sure we'll look back on this, but I think what it's going to do is move. I think everybody's agreed that it's going to move certain things faster, you know, and I think digital is at the heart of that, and how we use money is at the heart of that, which is where we come into crypto, I guess. But I think you're right. Even if you think back 5, 10, and certainly 20 years ago, there's no question that we couldn't have done any of this. From
no, absolutely.
You know, you know, you
imagine
can
this
imagine
happening in the 80s, John.
Well, it did. I mean, you know, even if I think back to when I first started working, you know, you were sending faxes. That was the way that you had to do. You know, some of our audience may not remember that, but that's when, if you had to do quick things, right? And you know, and senior execs had faxes in their homes. You know, but these weren't, and you know, there was no email, etc. You know, you think if we hadn't email, if all we had were faxes and, dare I say it, telexes, you know, it would. I'm not sure where we would be, quite honestly. It would be a very interesting experiment. Let's put it that way. You could see the whole thing, chugging to a halt, frankly. But digital has enabled, has enabled so much of our working, and the ability to speak to each other and to engage with each other in a way that we couldn't have thought possible. But there's been a surge in things and questions for us around it, things like electronic signatures, right? How do I sign documents electronically? I mean, these are pretty obvious questions, right? But many of our clients weren't signing many of their documents electronic as in a standard way. Now, of course, they absolutely have to. So they've had to figure out a way of doing that and doing it very quickly. But there's no going back from that. That's just one example of many. And I think if you look at it from the fintech's point of view, I guess fintechs, just like every business, are going to have a reasonably hard time or very hard time. But at the same time, I think it will ultimately, this will accelerate the use of, the stats are interesting. I think more than 50% of people have tried new payment channels during the COVID-19 lockdown. It's the number of people that are using shopping channels and online money channels in a way that they hadn't anticipated, I think is huge.
Well, this is the subject of an entirely separate town hall, isn't it? How really, digital in the case of the industries that you and I are involved in, fintech really contributed to the resilience and helping, get through what is a global health crisis. I couldn't agree with you more. It just wouldn't. I can't imagine, with all of the problems that we do see in the world right now that we're actively trying to address, that it would have really met those sort of requirements as resiliently had we not had the digital infrastructure and the banks, the fintech solutions that we've got in place today. And that's an excellent point. Let's shift gears and move on to some of our favorite community topics. DeFi, which in the case I'm always speaking to you, I'm co-joining with Open Finance. You're really a global specialist in global finance. I know that you advise is it the open banking implementation entity in the UK?
Yeah.
We start with DeFi. I mean, give us an idea of the use cases that you're seeing in DeFi, because DeFi, I think, can be a lot of things, but what's DeFi in your world look like?
Yeah, I mean, I think DeFi is probably one of the most interesting things, floating around in the last 6 months to a year in the kind of blockchain crypto world, particularly in financial services. And I think us as practitioners, as lawyers, and the regulators have a really tough time with DeFi, because if we go back, whenever I'm looking at new stuff, you have to kind of go back to first principles. So if you go back to first principles around financial services regulation, you don't regulate technology as such, right? I've had that discussion before, right? You don't regulate technology, you regulate the use of the technology, and it's the legal person, right? The company that's carrying out the regulated activity, the trading or the or the exchange or whatever that will be subject to financial services regulation from whichever regulator there's involved, and that leads to, I think, a really tough interpretation issue for people that are wanting to do decentralized finance. So the sorts of things that we're seeing, without going into huge detail, is that you've got people who are saying, I want to create a protocol, an open source protocol, in order to enable this sort of trading. So they may create some open source protocol and then put it out to the community and say, you guys can do what you want with it, develop it, take it in completely different directions. We're not in control of this, but we've started the process.
Yeah. So
so not only is that just software, but that's also software that no individual entity is in control of in any form. So how can you, and in which jurisdiction could that be anyway? So how does the regulator deal with that? So go back to first principles, you say, well, it's technology, of course they can't regulate it. But if you've then got the person who created the protocol then starts making money by putting an application on top of that protocol and doing some trading or whatever, again, you've got to think about, well, which jurisdiction is the customer in, which jurisdiction is the trading activity taking place in, that regulated activity? How are they making money? All of these questions are really difficult sometimes to answer in a sensible way. And I think, when we talk to clients, it's actually quite hard because, people want to create these protocols and want to encourage and facilitate particular types of transactions and get the community involved, because it's by open sourcing it and getting the community involved that hopefully you improve it for the benefit of everyone. But it's very difficult to then, for a regulator to pinpoint that it is under the control of someone. And, in a first principle way, usually we're used to someone being in control of it, right? If a bank decides to use a piece of software and they have what we would call an on-prem software license, right? So they would buy a software license. It's the bank that carries out the trading that would be carrying out a regulated activity, and no one else. The software provider is just providing the tech solution. They're having nothing to do with it. The bank's completely control. However, if the bank chooses to outsource part of its technology to someone, including, say, a cloud environment, and they would host the data and possibly even carry out some elements of the service, that's an outsourcing. Now, that technology company then themselves might require to be regulated and might themselves be carrying out a regulated activity. But even if they're not, they certainly would have to have a contract that with the bank that was subject to appropriate oversight from the bank, because it's effectively all part of the regulated activity, right? They're kind of outsourcing part of that regulated activity. So how you apply these things where no one's got control and no one's very sure of that I think is the real challenge with DeFi. It's figuring out who should be responsible.
You've just done a great job, I think, describing the nub of the problem in really a world of centralized governance, regulation, and central banks. It's in the name, central bank.
Yeah.
Exactly what the issue is. It is in itself not that the technology isn't resilient, or the technology won't work. It's just that it gets back to the fact of the facet of control and understanding who's responsible for things when things don't work, particularly when you're trying to protect consumers. And this is really, quite often at the nub of things. If we look a couple of years ago, I thought central bankers in the panels I was doing were quite often open-minded, saying, look, we've got nothing against an algorithmically generated decentralized cryptocurrency like Bitcoin. We just don't see a great use case for it in our world. Along comes Libra, BIS, the FSB, everyone, now is actually looking into central bank digital currencies, and the central banks have actually moved and said, well, maybe there is a role for digital currency, but it doesn't look as if it's a decentralized network. So things do move, but they do move really at quite a slow pace when it gets to regulation, particularly multi-jurisdictional regulation. Yep. So give us a view of what are the sort of use cases, or some of the apps that you're seeing in the area of finance come to market around DeFi. So,
I mean, it really can be anything, Lauren. So, I mean, if you think about it from the kind of most simple use case in a way is, non-custodial wallet providers, right? And there was, as you know, a whole debate around whether they should be subject to AML requirements, which I don't think makes sense, and I've been very vocal about that because, effectively it's your software, right? All you're doing is providing software. You're not in control of the keys, and I think, but right through, we've seen lots of different use cases around trading, around it really any peer-to-peer financial transaction that you can make can be done through DeFi, right? And really it does come down to a lot of this is quite nuanced, and I think we will get to grips with this. I mean, I agree with you that regulation does appear to move at a slow pace, and I think it does. But I think, to be fair to the regulators, it's not that they don't want to regulate this. I think the regulators have got quite a hard job because no one wants to regulate innovation out of existence, and some regulators, FCA being an example, have innovation as one of their principles, right? They're supposed to help nurture innovation. So how do you deal with that without stamping it out, but at the same time, how you fare with this new innovation and treating it in the same way as the existing infrastructure? And that's quite difficult when it's so new and so different. So I don't think it's straightforward for regulators, and I don't think, you know, they don't want to regulate too early. But at the same time, I mean, ultimately, my view on crypto and blockchain generally is, I think, you know, let's say 80%. I mean, you know, the percentages don't matter, but I think the vast majority of regulation that exists in financial services can be ported relatively easily to cover the crypto world. And I think it should be, and I think it should be a level playing field, right? If you look at where we got with KYC AML, you'll remember the discussions that we had at OECD two plus years ago, where they were throwing up their hands in horror and saying, we're very worried about KYC AML. And guess what? You know, we found a pretty straight, you know, relatively, and I know there's kinks in the road, and, you know, the travel rules very difficult, etc., and there's practical difficulties, but generally speaking, it's not been as hard as people thought to apply that AML regime to crypto, right? It's not been that hard, but it's round the fringes that it is really hard. So I think 80% of existing regulation, AML, you know, insider trading, you know, what, etc., 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 all the things that we know but not necessarily love, I think can be applied to crypto. But round the fringes, that 10 or 20% is really hard. It is really hard, and there's no point in pretending otherwise. You know, and having been, you know, basically a digital lawyer all my career, you know, since digital was a thing, what you find is that technology comes up and everybody throws their hands up in horror. I mean, the same thing happens all the time. Throw their hands up in horror and say, we will never apply existing legal principles to this new thing. This is so difficult. And then everybody, guess what, 2 or 3 years later finds a way. And we all kind of look back and say, why was that so difficult? Right?
Well,
and,
you know, again, it is, we're particularly with you and I, and the work certainly we do in GDF, are working with industry and the regulators just to help understand and unpick a lot of this, and at least try to accelerate it where we can accelerate it. And I don't think that anyone, you know, would you know, think that that's a particularly easy job. We've got complex jurisdictional laws, regulation, financial service regulation, and technology on top of it. So I couldn't agree more. I just have to point out for our listeners, John and I were at the OECD in the inaugural Digital Assets Conference. It was a couple of years ago, with a whole community of folks from our global digital finance community, with the task of defending the utility token, which we did in you know, I think with a great degree of energy at the time, given all of the signals were moving in, you know, in a different direction post Howey test. But I think you raised a very good point about the FATF travel rule, which initially took most of us, you know, by shock, particularly given the global market cap of digital assets at the time of June 2018, when there were murmurings of the travel rule coming, you know, relative to everything that was going on in the financial system. It just didn't make sense to us, but it appears to offer an opportunity for many more retail, you know, professional or institutional customers now to participate once, you know, in the market,
Yep.
once the travel rule was in place. So I think that, you know, people have really soberly sort of reappraised what type of opportunity that might offer. Let's change gears again and move on to open finance. So we've seen the called input from the FCA in the UK on open finance, and similar calls from the you know, Commission in Europe. But you know, give us a view from your perspective. Are any of these efforts in open consultation really helping us to bring digital assets or crypto closer to the mainstream?
Yeah, it's a great question, Lawrence. I think, you know, I think open finance for me totally makes sense, and I think it's very exciting. You know, I think people talk about open banking, you know, which is the existing infrastructure, as giving customers that, together with GDPR, which, you you know, I'm sure everyone on the call knows what GDPR is, may not know what open banking is, but giving them ownership of their own data. Now, being a boring lawyer, I don't think it does give people ownership of their own data, either of those laws. But what it does do is give them control over their own data. I think it allows them to, you know, use fintechs to get the data from the banks to use them in a way that suits them, and they can use whatever provider they want. And you know, it's been a tough journey for the banks to have this put upon them. Basically, it's been a pretty big technology burden for them. But I do think that as citizens and as customers, I think it's a really exciting opportunity to roll out the idea of open banking across financial services. So what that will do us is allow us to use whatever fintech we want to pool together all of our assets across our savings, our insurance, our pensions, and our bank accounts, you know, all into a common view and be hopefully better educated about it. I mean, the reality is we are facing a massive savings gap as a society, and this is not, you know, absent, you know, a very small number of countries, e.g. China. This is pretty much in every country in the world. We have a savings gap. People are not saving enough for old age, and we are facing a real cliff edge. And I think part of that is education, and part of that is knowledge. And I think to have the ability to harness digital channels and fintech to have that all in the one place, and hopefully to educate people and to, you know, use things like nudge theory, etc., I think would be really good. To your point about digital assets, I think that's one of the asset classes, but clearly, if people start to become educated and start to think about, you know, I have so much money that I can save. Where am I going to put that money? And for them to understand that actually there are different asset classes. They don't have to go to, you know, X, Y, and Z company. There are alternatives, and to lead to, I think, more of a democratization of finance, which is a lot of what the digital asset community started out as. You know, I think would be really welcome. It gives people a different avenue. You know, I think it allows some smaller companies to raise finance, hopefully in a different way that's potentially really exciting.
Well, you know, one of the key planks for open finance, again, is both the provenance of identity and
Yep.
You know, the protection of identity at least in Europe under GDPR. You know, which should allow the safe conduct of transactions. So, you know, putting Wirecard aside, which is what everyone has been speaking about over the past couple of weeks, particularly putting it aside in the case of what the root cause issues were, because clearly things are centering around an audit issue rather than particularly an open finance issue per se, but it certainly has put open finance under the spotlight. You know, what are the particular constraints you think that the FCA or some of the European regulators are going to be looking at as they consider crypto or digital assets within the context of this emerging open finance landscape?
Yeah, I mean, just drawing some of those threads together, because it's very interesting you mentioned Wirecard as well, Lawrence, and again, without going into the details of that. But I think what the Wirecard saga has shown us, and when you move into open finance, is that all of the pipes matter, and understanding where the pipes go and who's in control of what bit of the pipe matters. And comes back to my point early on of kind of operational resilience. And by operational, you know, as you and I know, having been involved with financial services for a long time, financial services is very, very complex value chains, often that very few people actually understand. You know, where there are, you know, huge numbers of parties involved, and you think, why have we got all these people involved? But there are historical and or very good reasons why they're there. And I think, you know, one could argue that some of these could be simplified, but I think what matters is that you go in to a transaction, whether it be in a crypto or a digital asset or using cloud environment or whatever it is, or just some other technology, you understand who is doing what and who's responsible for what. You understand the value chain, and you understand what your place is in that value chain and what everybody else's place is. That's actually probably the single thing that I spend most of my time talking to clients about, actually. But coming back to your point on open finance, you're absolutely right. So with open banking, it has been relatively simple because we've had the new Payment Services Directive, PSD2, and we've had the CMA order that covered the 9 biggest banks in the UK. And that, together with GDPR, has meant that the banks have been forced to open up their data to the fintechs if the fintechs are appropriately regulated by the FCA or another national competent authority in Europe, and it's all been pretty straightforward. With open finance, there's a big debate going on. Should it be a mandatory regime like the new Payment Service Directive, PSD2, or should it be voluntary, or should it be a sort of combination of the two? And that exactly comes back to your point of provenance of who's asking for the data. Does that person have the authority to ask for that data? Do we have we been able to authenticate and identify that person properly? Is there a privacy issue with giving that data, under GDPR? And people get quite jittery now under GDPR because, you're facing a very large fine if you get that wrong. So there are lots of issues to think about. And it's very easy to, the FCA call for input, I think, is really welcome. And we're involved in a number of industry initiatives around this. And I think, personally, I would like a combination of probably some mandatory regulation that gives people comfort together with an industry-led approach that has that flexibility. Because honestly, I've spent the last, I've been with Hogan Lovells now for almost 4 years. I've spent 4 years advising on open banking and PSD2 and the implementation of that and how you do it. And the rules have been moving throughout, and they're very difficult to interpret because they're many of them are they're either they're obviously drafted in at European level, and then there was some delegated legislation by the European Banking Authority, and very difficult to apply right across the board. And inevitably there are gaps, and regulators go for technology neutrality, as which basically means it's very difficult to then apply in certain situations. And that's not necessarily the regulator's fault, and there was lots of lobbying, etc. too. So, I think having, some industry-led approach, I think would be good for the industry and hopefully good for consumers.
Well, that's great, and I need to remind our listeners as well that John is a keen supporter of our whole focus on what I would call DeFi RegTech, which allows industry to at least help lead and hopefully put some of the RegTech solutions in place that are outside of the regulated perimeter or on the perimeter until we get some of these things matured. And it's something that, you and I in the community are continually focusing on with codes of conduct standards and that next stage of where we go with having industry really self-certify and demonstrate to regulators and policymakers that it can take care of itself. So absolutely. All right, now let's shift gears again. You are a specialist when it comes to the the European landscape of crypto digital assets regulation. So can you give us a sort of an overview from 40,000 feet of that landscape? And let's talk about new entrants. New crypto digital assets company coming into Europe. Who are the top jurisdictions that I might be looking at or considering in order to, reside my company in and get my permissions and some licenses?
Yeah, I mean, I think the European landscape is really interesting, and I do quite a lot of talks and things in the US, and of course the US think of Europe as one place and one thing, whereas as you and I know, it's quite difficult. And I think the challenge And the opportunity that we have in Europe is that it is the problem of kind of regulatory arbitrage, and an inconsistent playing field throughout Europe. So, and the European Commission has recognised that. So, from an EU perspective, the European Commission understands that there is an issue, and in recent papers has made it clear that there isn't a level playing field, and they are concerned about regulatory arbitrage. So you've got a number of things being bubbled along. So if you look at the past couple of years, you've had Malta, Gibraltar came out first with their regimes, which I think were a great step forward in lots of ways. I think Gibraltar is quite simple, but quite effective, and it kind of gives some legitimacy to the players there. I think the Malta law, I think, is a lot more detailed, and a hugely impressive piece of legislation, and it focuses on a kind of opt-in regime, giving legitimacy to the different parties, and focuses a lot on the kind of the ICOs and the digital services providers around crypto. But Malta were very careful to make sure that it did fall within existing EU structures, within MiFID, and I do think it's been really good to see that level of innovation and going through. And then you've got France and Germany, who came in behind Gibraltar and Malta, but have moved pretty quickly. And again, looking at what they're doing, I think it's very interesting. France and Germany are clearly trying to set themselves up as a good place to do business in crypto, but they've taken quite different approaches. So France is very much a kind of opt-in. Here's a voluntary regime that will give your business legitimacy. Whereas Germany is more a kind of all-encompassing regime, particularly around custody. So everyone has adopted slightly different approaches. So where does that leave us? Well, I think there is appetite now within the EU institutions to move forward, and I think on an EU-wide basis. And as I said, there is concern that we have all these different regimes, which, as you say, Lawrence, if you want to set up in Europe, or as we often get clients come from the US and saying, "Oh, where should I set up in Europe?" And you're kind of going, "Well, pick your choices." And just because you fall into one regime doesn't necessarily mean you fall into the other ones, which is obviously not what the whole EU vision is. So the EU Commission are very keen, and have issued a paper to that effect to try and pull this together. I think the interesting thing will it be a French-led approach or a German-led approach? Because those approaches are quite different. So Germany has the presidency, as you know, at the moment, recent comments coming from the Commission would tend to suggest that maybe it's going to be the German approach that prevails rather than the French approach. But I think there's a lot of lobbying and a lot of kind of getting ready, juxtapositioning that will go on in the next little while. And I think it's going to be really important for the EU as to which of those visions prevails.
Well, and one thing for certain, it is not going to be a UK-led approach, which, over the past 40 years, often it has been. And, looking at the number of, initiatives that have come out of the FCA, playbook, handbook, including things like MiFID 1 in the early days, I think we'll just have to watch this space and see. But then, where does this leave the UK, and what is the direction of travel for the UK in the crypto digital asset space from your perspective?
So the UK is definitely taking a more passive approach. I think the FCA has put out some very useful papers, making it clear that existing regulation applies to crypto. but absent the AML rules, new AML rules for for AMLD5 and to follow the FATF rule, they haven't done anything new. They did say in the last budget that they were looking at some work around stable coins and looking at central bank currencies. So we might see some work coming through from that. And they've done some really good work, scoping out what might happen through the crypto asset task force, but there hasn't been a firm response. So I think post Brexit, whatever you think about Brexit, it does give the UK a really interesting opportunity to say, well, again, depending on where we get to in Brexit negotiations, to say, well, we have a clear opportunity not to be hidebound by whatever Europe, the EU decides. We can do our own thing and set out our stall. So I think that's really interesting. I think the UK has a real opportunity to do something really interesting, and they've got great people at the FCA. They have done a lot of the scoping work already, and I'd like to think that the UK has got a very vibrant fintech ecosystem. We actually asked the FCA how many people have applied for the license for AML, and I think it's 123 or 127.
Wow. But this was by the end of June deadline.
So the end of June means that you are guaranteed to get that they will look at it by January.
The case will be reviewed by January.
Yeah. Because obviously you got until January the 10th. So I'm guessing there's still quite a lot of people in addition to that, Lawrence. So that's a huge number, right?
Yeah.
That's a huge. So I think there's a very vibrant crypto blockchain community in the UK, and the UK is still a very attractive place. When we talk to clients about, do you want to do Malta or Germany, France, UK, many people do plumb for the UK still. For lots of reasons.
I mean, what's just quickly, John, without getting into the details of Brexit and withdrawal, but what's the status if I'm a global crypto VASP, looking at the UK and thinking it might be progressive, but into 2021 post Brexit, where does that leave me in terms of equivalence or third country regime?
I mean, the short answer is, Lawrence, we really don't know. You read the runes, right? And negotiations don't appear to be going terribly well. So you could look at it one of two ways, Lawrence. Either there's going to be some form of deal and some form of equivalence, but what the according to press, etc., the EU, are and the UK, I think, are struggling to reach agreement on what that might look like.
Yeah.
So, I'm trying to, I'm trying to focus on the positive thing. So either we get that, and we do have a shared regime with all the benefits and some of the downsides that brings, or we have the ability just to go our own way and do our own thing.
Well, and I think that quite often in the crypto markets, per se, again, regulators, policymakers have this view that there's a huge retail participation, and I think the numbers you and I always look at, John, certainly there are a large number of retail customers, but broadly represent 15% of the total value of the transaction size, which is professional, increasingly institutional markets, the growth of the spot market and OTC, and the growth of derivative market, in crypto since last year at this time, last August. But London is a global financial center, and certainly the professional institutional growth of that side of crypto or digital assets, including some of the points you're raising earlier about new capital formation, the opportunity to get capital onto balance sheets of newer companies quickly, surely should be an opportunity that the UK is looking at and the City of London is looking at, regardless of what the Brexit scenario is.
Exactly, Lawrence. Exactly, and I think I think there is a real opportunity. You know, either way, I think there's an opportunity for the UK, but I think we need to make sure that as an industry, we engage with the regulators. You know, coming back to your point, which I thought was an excellent one earlier on, the industry needs to take responsibility and take leadership of this. You know, this is not waiting for the regulator to do or not do something to us. You know, we need to embrace this. We need to, you know, make sure that the regulators are educated. We need to make sure that the industry itself is educated as to, you know, and not naive for sure. But I think clearly we also need to educate the regulator too and tell them, you know, that these are the opportunities. You know, this is a fantastic opportunity, but let's grab it with both hands. You know,
well,
and
again, I couldn't agree with you more. And you know, John, for certainly your whole tenure at Hogan Lovells, you and I have been involved in very front foot advocacy work with regulators, not just in the UK, but globally. And you know, it's often thankless, but in the early days, I used to say regulators need friends too, particularly in industry. Regulators have lots of good friends, but I think the closer industry works with regulators, particularly where we have new technology. I love your point of first principle. You know, technology folks quite often don't understand that regulators aren't regulating technology. You know, this whole focus on the security token market, post-utility tokens. Yeah, one of the narratives I've had in the community is, look, we've got securities laws in most countries. What kind of regulation clarity are we asking for? You know, we've had a bit of what I call a Gordian knot in you know, custody, and custody gets difficult when you've technically got bearer instruments. You know, it's back to discussions you and I have long had about the role of a registrar and having to give provenance or identity to bearer shares in order to certainly keep institutions happy to trade in that space. But, you know, I think that the collaboration with regulators and trying to flatten some of that risk just by opening up how these technologies work and particularly what risk they present to different counterparties in the ecosystem is really where the future needs to go if we want to accelerate any of these technologies who ultimately who think are going to benefit consumers, small businesses, institutions, etc. So you know, it's a great point though. Regulators don't particularly regulate technology. Let's just move on to one last point now. The privilege of seeing the Hogan Lovells blockchain toolkit last week, and I was super impressed. And so my takeaway, I'm not exactly sure all of the things that it does, but I think listeners would be you know, particularly interested in this, because if I'm interested, you know, broadly in any you know, policy, regulation, anything to do around the crypto digital perimeter in any country in the world, I can kind of, you know, put it into the search engine and then get a result of what's going on in that particular country. Is that, did I get the right message when I was looking at things? Is that what the tool was designed to do?
Yeah, I mean, we've now tracked over 1,000 pieces of legislation, proposals, you know, reports, whatever you want to call it, across the piece. And, you know, what over the last, so that's been over the last kind of 3 to 4 years. So if you think, Lawrence, when you and I first started talking about this, you know, and certainly when I used to go and see banks and fintechs and blockchain companies, and you say, so what is the, you know, can you tell us the sort of legal and regulatory infrastructure around blockchain? You say, well, there's all of this stuff over here that ultimately will apply, as we talked about earlier on. But there was nothing specific. There's nothing specific, and even it was quite uncertain at the time about how you apply existing rules. Now there are quite a lot of specific rules, and we've got lots of guidance from regulators as to how the existing infrastructure is applied, and all of that is being tracked by our toolkit across, you know, I think we're kind of 80 odd jurisdictions, you know, so it's hugely powerful to see that. And you know, we talked about AML and how we've got lots of AML rules now around the world, but there are, you know, quite a few other rules now coming through around the world, and hopefully this will help people, because, you know, it's why global digital finance is called global digital finance. You don't go into blockchain thinking, well, I'm just going to stay in the UK, or I'm just going to be in Malta. This is global by its nature. So I think it's really important that people understand how these laws bite in the various different jurisdictions. So yes, it's about where you locate and where you might have some of your infrastructure, but I think it's also about how do I sell to customers? How do I, or do I need to block off people in the US, or China, or whatever it is, So those are the hopefully that will give people the tools and the ability to do that. And I think we've worked really hard on it over a long time to put this together, and I think it's really exciting.
Well, looks really cool, and it'll be rolling out sometime in the autumn.
Yeah, in the next couple of weeks, hopefully we should have it done.
Fantastic.
And dusted.
Now, I have to say, John, I've been remiss. I've been always you and I chatting away here, and I've not focused on some of the questions. So we've got 8 minutes left. Let's try to get through as many of the questions as possible. Number one, how competitive, attractive is the EU's approach on a global scale? Would you say clients are looking at Europe as a good place to locate, or are there other jurisdictions that are more desirable? And if so, why?
I think people largely regard the EU as a good place. I mean, I think people have, there are obviously issues in places like China where there was a ban earlier on. I think there have been, well-documented issues in the US as well, and the SEC has been aggressive in chasing people down. The other challenge you have in the US is you have lots of different regulators and different state regulators and etc., which makes the US quite difficult. That said, there's lots of capital in the US and there's lots of advantages about the US. So, I think parts of Asia are still attractive. Hong Kong, Singapore, have long been favorites for crypto companies. But I think the EU is attractive, and certainly, I think if you look at it's got a pretty dynamic infrastructure with good talent, because it's not just about regulation, right? But I think, yes, I think the EU is a pretty good place to do business, and I think the regulators are pretty supportive by and large, and I think the policymakers understand that this is an important area, and I think have tried to probably move faster than some other places.
I'd concur with that, and I think certainly post-China ban of Bitcoin and post-Howey test in the US, the European Union has really been the #1 destination for both Chinese, Asian, and larger US firms in our global digital finance experience. So again, I don't see that changing in the short to medium term. But
no.
It's watch this space. It's a pretty quick moving space. Okay, question 2: where do people want to locate themselves? Where do clients look to situate in Europe?
Yeah, again, it's a great question, and there's lots of different reasons why you locate in certain places. As I mentioned earlier on, we have lots of people come to us and answer that very question, and we've got some tables that we produce, comparing. You recall, Lawrence, Switzerland was a big favorite for quite a while, and now that really has gone by the wayside. I would say generally people don't go to Switzerland, in our experience, and it tends to be people are probably more focused on Malta or Gibraltar.
Gibraltar and Malta over the past few years have probably been
but then you've got Lithuania and Estonia. And lots of people come to places like Germany or France and the UK. And some people, frankly, prefer the larger, what you might call the larger European jurisdictions. And I think, certainly some of our clients will say, I'd rather be in the UK and have the FCA badge than the Malta Financial Services Authority badge. Now, there's no particular reason why the Malta Financial Services Authority badge is not worthy of consideration, but that's their view on life, right?
Yep. Yeah, great.
So, I think
people, again, if we discount retail and you're talking about capital markets, you go to the capital markets. So, when you look at some of the plays we've seen come out of the London ecosystem on either the exchange custody front, they're focused on London, they're focused on Frankfurt, they're focused on Paris, they're focused on markets where there are capital markets in Europe. Absolutely. Right, next question. You've mentioned that 120 plus firms have registered in the UK with the FCA. Where would you say most people are looking to locate in Europe? Again, is it the UK? You mentioned Malta, Gibraltar, France, and Germany. So I think we probably just partially answered that. Where do your clients often look to locate?
Yeah, I think we've answered that really, haven't we? You know,
Yeah.
but it's interesting. I think that 120 plus number is interesting. It shows the interest in the UK, right? I mean, it's a much higher number than I thought it would be.
I think it's fair to say if you're a larger player, you're probably in a number of European, a number of European countries right now, but you might not ultimately have made a decision of where your ultimate European head office is. I don't know if that hedges the question, John, but we've seen a bit of that, haven't we?
Yep.
Yeah. Has the blockchain toolkit been launched? Is it open to anyone, or is it just for Hogan Lovells clients?
So,
weeks.
Yeah, it will be launched in the next couple of weeks. It will be open for anyone who registers, and there'll be some functionality that'll be free, and there'll be others that will be kind of reserved for clients, etc. So, but I mean, as Lauren said, watch your space, and we'll obviously let you know more about it.
Yeah, we'll roll out the freemium version to all of the GDF membership for sure. And then lastly, when we talk about DeFi, it is often done so through the lens of removing the intermediaries, such as financial institutions. However, do you think that financial institutions have a role to play in this? Wow, great question.
Yeah. In summary, I think, in the discussion that we had on open finance earlier, I think it's quite similar, right? Financial institutions can absolutely embrace this. I think they can completely embrace this, and I think should embrace it in the same way that the big banks have embraced open banking, and are looking at how they use this. So I think DeFi gives the banks have significant advantages. Some might argue they have disadvantages too, but they have significant advantages going into something like DeFi, right? They can, they understand the operational difficulties, they understand risk management, they've got, fantastic people who are steeped in all of this. And so for them to pivot some things to DeFi, I think is a real opportunity. That said, obviously, part of why DeFi exists is to take some of them out of the equation. So, if DeFi does come to pass in some way, then banks will potentially lose some of what they do today, but there is an opportunity for them to gain some other transactions, but that does involve them actually embracing it.
I love that answer, John. And I would say from my experience, many of the savvy bigger banks are looking at the opportunity of DeFi. So again, watch this space. We are just about at the top of the hour. John Salmon, tech partner, Hogan Lovells, can I thank you very much for joining us today on the Global Leaders Series. It was a fantastic chat and a pretty quick canter through some pretty meaty topics.
Thank you very much. And thanks, Lawrence, for having me. It was very enjoyable. Really enjoyed it.
Pleasure. Just a reminder to everyone, our next Global Leaders Town Hall is on the 14th of July, when we will be joined by Linda Lacewell, the Superintendent of Financial Services at the New York State Department. So thank you again for joining us, and goodbye.
Thank you. Bye-bye.